lovely to see so many of you here today. It's a very lovely couple of days. The weather is beautiful, and my God, I feel like I'm giving you the weather forecast every time that we meet. But it is still very, very, very nice to see you here. Last time we talked about some complicated stuff, right? We talked about Article 35 of the CISG, which deals with conformity. Conformity is tough. It's a tricky topic because it answers the basic question of how do we know if I have received whatever I purchased? How do we know if the agreement is breached? And that was a topic for which I said I cannot think of a single year's exam which didn't include it in one way or another. So again, we're going to circle back to that, and we're going to practice, and we are going to get to the bottom of that topic, but today we're going to put it in a bit broader of a system. So the plan for today is to continue with some of the rules which kind of come on top of the assessment of conformity, and then see how the Article 35 assessment fits into everything. Now, I don't know how well you remember last week's dive into conformity. The main point was that we had Article 35, which tells us that the goods need to be in line with the contract. Right, I purchased blue cars, you have to deliver blue cars. That is obvious. Now, how do we know what the contract says? To know what the contract says, we need to interpret it. We can't just use regular, normal words. We have to figure out what it actually means. To do that, still, we're here. We're going to ask, did the parties know? Like, did the parties know what each other meant? Or what would a reasonable person say? So that would be our main kind of rule. I order blue cars. You deliver cars which are, let's say, of this color. Have you breached the contract? Well, for some people this is going to be blue, for some people it's going to be green. For most people it's going to be green. I think there is a website like Is Your Blue My Blue? Apparently people see blue and green very differently. The point being, you deliver cars in this color. We didn't really agree, we didn't pick the color in the agreement, we just said blue. What happens? We ask, did the other person know it's going to be of this color? That maybe have to prove. Or we ask, well, would a reasonable person say that this is blue? With me so far? And this here is basically Article 8 legally. We have to read the contract to know if the goods are what they ordered. We start with, did they actually agree on this color? We move on to what would a reasonable person say. That's our starting point. But then there are some more criteria under 35. One was that it has to be fit for a general use. Fit for a general use, this car has to be in a drivable state, unless the parties agreed something otherwise, so it can be driven. Drivable, I don't know if that's a word. The second one, specific use. Specific use is just something like there is a special purpose the buyer had. Buyer asked seller to help pick. I ask you for a car which can be used for driving on gravel roads or whatever, and you say, buy this one. That's another. Then we have a model, like it has to correspond to the car you've shown me, and then it has to be also packaged in a normal way. If one of these things is not in place, you can say what you have delivered is not conforming, you have breached the contract. So that is Article 35. Again, don't worry, we will see what that looks like in practice, but I want you to remember this general framework for now. I hope that so far is fine. But then what are we moving on? Why did I say that there is a bigger picture to this? If we can hold that you have breached the contract, we will see there are some consequences. And where we take it from here is basically what we're going to discuss today. But before we see what happens if there is a breach of contract, there is another line of issues, which is what we call passage of risk. This one is tricky. It's tricky because it's simple. It's simple to remember, but it's tough to slot into the entire system. What does it mean? Passage of risk is a question which tells you who pays if the goods are destroyed. So the question sounds simple, right? So let's say that you have sent me apples today, right? I've purchased apples from you. You have asked somebody to carry them over to me. If they get destroyed at your factory, if they get destroyed at my place of business, if they get destroyed in transit, do I still have to pay? The reason why this is a question and why it's not obvious is because, as we've seen the last time, there was this situation where when the seller sends the goods, but the buyer doesn't receive them, they could still be considered to be delivered. Basically, here is the main rule. Loss of or damage to the goods after the risk has passed to the buyer does not discharge him of obligation to pay the price, unless the damage is due to an act or omission of the seller. In plain words, this just tells us one thing. It means that when the risk passes, when there is this moment in time when the risk goes over, risk as a legal concept, after a certain point in time, right, even if the buyer doesn't get the goods, they still have to pay. So there are situations where I purchase apples, I never receive them, I still have to pay, and I can't request new apples. So that's the question we're looking into today. That's the passage of risk. The one exception is if the seller caused the goods or the damage to somehow occur. And the rule here is pretty much like one that we have seen with the delivery. If there is carriage of goods, if we are using a third party, like a postal office, to carry the goods to the buyer, the risk is going to pass when we hand them over to the first carrier. All of this, again, may sound a bit complicated. All it tells us is basically this. So the goods, let's say I'm selling you cars, cheese, apples, computers, whatever. Let's do computers. Apple had a new event. We have computers, right? And we have a seller. Let's say Apple. And we have a buyer. Let's say that BI is giving free computers to everybody. So let's say, yeah, BI, yay. So let's say that BI is a buyer. The goods, we're going to pay, let's say, 10 million, whatever. And we're going to get 100 computers. Okay, we have entered into a contract. Say that Apple is in the US. And say that BI is in Oslo. The goods have to travel from the United States to Oslo, right? They have to travel. And then, at many different points, things can go wrong. They can catch fire, they can be stolen, they can be damaged. So the question is, if they're damaged here, if they're damaged here, if they're damaged here, here, at which point is it so that BI is now considered to have assumed the risk for the destruction of the goods. And the first rule, which we find in 67, tells us that if Apple is to hand over the goods to somebody like carrier, I'm using always FedEx as an example, mostly because they are truly horrible. But let's say the contract requires us to hand over the goods to FedEx. At this point, when Apple hands them over, the risk goes over to BI, which means anything that happens from this point on is BI's risk, BI. BI has to cover any damage to the goods. If laptops leave New York and they sink before they get to Oslo, BI still has to pay. Apple doesn't have to deliver new computers. Is that clear as a concept? I know it's not very intuitive, but that is the main rule. There is a point of time. It's this point of time by default, handed over. It is this point of time that the risk for destruction goes from Apple to BI when they've handed it over to FedEx. Are we good on that one? So, one exception there is if the loss is due to act or omission of the seller. The act or omission of the seller would mean something like Apple has put these goods on a ship, but they were so prone to taking fire, they were substandard, the batteries exploded, right? In that case, even if it happens afterwards, BI would not have to pay, so the passage of risk would not be triggered. But that is the main rule, right? Two examples used here. Exactly that. Apple ships iPhones to Combat, handed them over to FedEx. They're destroyed before they reach Oslo. Fine, BI still has to pay. Apple doesn't have to send new iPhones. If the plane crashes because they were poorly made, we have the opposite. So Apple has to send new laptops, BI does not have to pay. Otherwise, there is a breach of contract. Is this visible? Should I take a photo and put it on It's Learning? If it's visible, I'm fine. If it's not visible, invisible. Okay, let's then pick it up from here. So the rule is that if we don't have any contracts of carriage, we can have the passage of risk taking place if the goods can be picked up and you don't use that in time. That is also kind of natural, like you have 7 days to pick the goods up, you don't show up, you don't do anything. In that case, also the risk will be passed on to you. Again, this is just in the contract in which we don't have carriers, which is not really going to happen often. So we can put that one a bit to the side. We have a small case here, but I think I would prefer us working with cases a bit down the line after we have done the damages part. But let me see. You know what? This one is tough enough that I can give it to you later. I'm doing it later. But the rules are simple, I think. The passage of risk has to be a certain point of time. Now, you may remember that people have agreed that anything in the CIHD can be basically modified. So if the CIHD says the risk passes when you give it to FedEx, you can also agree something different in the contract. So you could have a clause saying, no, the risk will pass when the ship passes London, or no, the risk is going to pass when it reaches Oslo. You could have different commercial setups there. Now there is something called Incoterms, and this is the industry standard, pretty much. It is a set of rules, contractual provisions, basically, which is made by the International Chamber of Commerce. It's not binding. People can choose to include or not to include. If the CISG says something else, they will prevail again because they are basically contractual and they can, like anything in the CISG, can be overridden. They're a contract, hence they can be overridden. But what are they really? Think of them this way. It's like 3-letter acronyms which are supposed to tell you who bears the cost and when the risk passes. I'm not really too keen on ever examining on this because I think it's interesting for people who are doing shipping, which could be some of you. But the main point is, in any case, that these are just contractual provisions, as you can see, which say, for example, the risk is going to pass from the point that the seller makes goods available to the buyer at their factory, or it's going to pass when we put it on board of the ship after it passes like the boundary of the ship, or while it's being loaded. So basically people are trying to regulate at which point of time is this loss going to be considered buyers. And yes, you see quite clear example here. We would have to decide, would it be at the factory, would it be at the terminal, what about the customs, who bears the cost? And the reason why Incoterms work is because they're just a shorthand, right? They give us a little kind of short way of regulating this in 3 letters. But once again, this is not something which I'm too interested in for the purposes of this exam. Know that they're out there, but you don't have to know the individual ones and what they do individually. So just the main effect of is what I'm kind of looking after here. We have conformity, we have passage of risk. Now, here are a couple of tricky scenarios. One of them is, what happens if the lack of conformity is established after the risk is passed? This is a really, really, really tricky one. And for some reason, it's so easy for people to just go into conformity and to claim breach of contract and to forget the rules on passage of risk. I can show you the exam, actually. Let me just find the exam problem from this year's last year's, obviously. I don't have one for this year. Yeah. I'm just going to share and show what that looked like. Never in my life has Microsoft Word crashed. Let me just try to link them to you to, sorry. It should be available for you as well. So what we had here, so this was last year's exam in December, so I'm guessing the extraordinary exam or whatever it's called. We had a manufacturer of board games. which licenses major IP franchises. They have a board game based on Game of Thrones. We then have a Norwegian company which is selling video games. In 2025, they visit fair in the US and they see some board games. Immediately now you should be thinking, okay, it's probably important that they got to see them in person for the purposes of conformity, but later on that. So the games were loaded on a plane operated by SAS. The plane experienced turbulence. As the cargo shifted, packaging ripped, pieces fell out of the box and were lost. 50 games were affected. When they picked them up, they did not notice that the pieces fell out and lost some additional stuff. And then we have something on damages. But the point is simple. We have an American company selling board games. The packaging ripped on top during the plane ride, and some of the pieces ended up being lost. The question was, well, first, is CIHD terms applicable? Fine. How many games can they demand to be replaced? So here, the first instinct, right, is to think, well, they have purchased this amount of games. Some of them were missing pieces before they received them. And in any case, they should receive the games in line with the contract, in line with the model. But what you would miss in that case would be that this is also a question of passage of risk, right? Yes, sure, you can go through conformity, you can establish that the pieces were missing, the games are not disordered. But that would be a mistake because obviously what happened on a flight what happened on a flight. It happened after the goods were handed over, and for whatever happens after the goods are handed over, the risk has passed and the buyer doesn't have any additional claims. So watch out for it, because it is very, very easy to forget. It's very easy to go into the discussion of, yeah, but here they lost some additional pieces. Should that count? Should that not count? Don't forget the passage of risk. We also had the question about if they were technically playable without the missing pieces, would they be able to request a replacement? So here we once again have the question of how did this loss occur? Starting point, if a contract is for sale of a game, there is no need for you to go through fit for general use, fit for specific use. You can look into the contract. You can discuss whether or not there is this duty to check if the goods are fine, but in any case, the rule of thumb here is to keep it simple. Conformity analysis, again, yes, we would look into do they correspond to the contract, do they correspond to the model. If you can solve it in a simple way, then you solve it in a simple way. I don't know if this appears to be a bit scary and too complex or too simple. That could be the case too. Again, I want you to remember these two sets of rules. They are important. 35, 8, and 66. So if that is the case, and let me just jump back to the questions I'm going to quickly jump through letters of credit. I'm going to hop over them for now because they're complicated and they don't really fit into this entire system right here. But let's assume that the risk has not passed, or that the risk has passed and the goods are non-conforming. Actually, no, you know what? I want to go back. I want to ask you a question. Okay, so let's actually take that example from the sample example. Right, we have board games, which were whatever, missing pieces. When did that happen? That happened during the flight. Right, that happened during the flight, which is why the risk had passed and there is no claim. If it had happened before the flight, there is a claim. But now you can also think about stuff like this. Say that we go back to the first example. I order a blue car. So I order a blue car. And I receive a green one. I'm always going to have a non-conformity claim, right? I have ordered blue, you have delivered green. There is nothing with passage of risk, which is kind of really happening here, unless it turned blue on the flight or something, right? The main point is, did non-conformity occur before the risk has passed, or did it occur after? For some types of non-conformity, it's going to be very, very difficult to argue that it occurred before, but for others, it's going to be easier it's going to be easier to argue that it happened later. You buy ice cream melts, right? Did it melt before you handed it over to a carrier? Did it melt after? So, you know what, just in case, I am going to take a photo of this and to transcribe it in some sensible way, if possible at all. No, it's still crazy for some notes. Okay, fine. I'll deal with it. That is how we find out if you've breached the contract. What happens if you do? What happens if you did? There is a set of rules which is about what we call damages. What is the point of damages? The damages are amount which you have to pay due to a breach of contract. So think of it this way. What do I have to do if I deliver, if you purchase 500 apples for $50 and I don't deliver those apples? Obviously I have to either deliver them or give you back what you paid for the apples. But there is an amount which goes on top. There is an amount which goes on top which is called damages, which compensates you for the harm which you have suffered, for financial or non-financial loss. And you can in principle always request this. I purchased a blue car. I received a green one. Because of this, I had to spend some extra money. Perhaps I wanted to have an exhibit of cars and I missed the green one. I had to hire somebody or whatever. Board games, I purchased them. I didn't receive them. Maybe in addition to having paid for them and getting that money back, maybe there was some loss of customers. I purchased the computers from Apple. Maybe in addition to, obviously, having the cost of the computers be at issue, maybe there is also some additional harm, financial or non-financial, which I have suffered. And this area of the CISG deals with that. So the question of who pays back the price is one question. Whether or not they have to pay back, right, due to a breach of the contract. If there is a breach, yes, the price has to be refunded or paid. But if the other party has suffered some harm outside of paying for things, that harm will have to be compensated. So what goes into the calculation? We have any loss, including loss of profit, suffered by a party who did not breach the contract. So as a consequence of that breach. So once again, the simplest way of conceptualizing is you didn't deliver bananas, did I, because of that, suffer some kind of a consequence, loss of profit, extra expenses. So it only includes, however, the loss which the party reached foresaw or should have foreseen at the time of conclusion of the contract in light of all the circumstances as a possible consequence. What does that mean? So let's say something like this. I'm going to switch over here so that I can type. So let's just do a hypothetical like this. So we've seen the first question which we have to ask is, of course, is there a breach? So, for example, are the goods non-conforming? And here, let's use the example of Apple. Apple delivered slow MacBooks. So, are the goods non-conforming? Apple delivered slow MacBooks. What would we do? Under 35, we would ask first, is this in line with the contract? And then we will look into fit for general use, blah, blah, blah. I'm just going to say that that is the legal test under 35, but that is not what's important right now, so I'm just going to minimize it like that. So are the goods non-conforming? Apple delivers slow MacBooks, so let's assume yes. The second question relevant there would be, did the risk pass? When handed over to a carrier, parties can agree differently. So where does that put us? That is basically the summary of what I've done up there. That puts us here. It just means that we have non-conformity. Before. Seller has to deliver the goods. After, buyer has to pay, regardless. So let's assume that the seller has breached the contract. So that was what we did before, but now into damages. So let's assume that there is a breach. So that would be the main thing for damages, right? And let's assume that the seller has to pay, that the seller has breached their obligations. So let's say in this case, the seller has delivered slow MacBooks. What do they have to do? Well, first, they have to, assuming a breach, first, they would have to give, they would have to send proper MacBooks or refund in entirety. Let's assume that is 1 million. Back and forth. So that is what they have to do. They have to send proper MacBooks or refund in entirety. But maybe the buyer had some extra losses. Say they had to rent PCs while waiting. Or they lost reputation or whatever, lost clients. Seller would have to cover that extra damage too. So this is not a part of the 1 million. It is a part of, let's say, 100,000 for renting pieces. Because the whole point is, if there was a breach of contract, we have to not really punish, that is not the point, but we have to restore both parties to the state where they were before. There is the foreseeability requirement, however, and where does that fit in? So just to show what I'm talking about, what is the second part? The second part was this, right? You have the right to claim breach of, as a consequence of a breach, any loss, including loss of profit. But then we have the second part, which tells us, yes, but that has to be foreseeable at the time of conclusion of the contract. So what would that mean in our context here? So again, back to hypothetical, we get slow MacBooks, obviously money back, but obviously some extra costs, like 100,000 here. But what were these costs? So say that these costs are, we used renting alternatives. That one, at the time of conclusion of the contract, is foreseeable. A reasonable person would think, if I don't deliver MacBooks, obviously it's fine that this other party is going to rent PCs. But let's say that the seller gets this claim from a buyer who says, I had to hire people to calculate pay them 1 million per day. Say that they do actually do this. So instead of renting PCs or buying PCs, that the seller says, yeah, I have lost extra money because I had to hire people to actually do this for me. Obviously, that would put the seller in a rather unfortunate situation, like how could they expect when they sold laptops that if they don't deliver them, the natural thing to do is to hire this amount of people, so or to hire people at all to be dealing with it. Or say you're selling pickaxes to someone, Minecrafting, right? And the delivery is late. Fine. In the meantime, somebody discovers gold under the house. And then they're claiming, oh yes, had you delivered this in time, I would have been able to dig and I would be able to actually get to this gold. The question is, should that be covered under damages? Should they pay for the fact that they didn't get the gold? And the answer is no, because when they concluded the contract, there was nothing to indicate that there is that kind of gold, and that failure to deliver the pickaxe would actually end up interfering with a situation like that. So the requirement of foreseeability is just, could a reasonable person, when the contract was concluded, know that the other one would be harmed in this way? So that is the basic framework here. Not so basic, I assume, but manageable. So where do we then move on? So we have those two requirements. Foreseeability-wise, the thing which I kind of already mentioned is that it's not the exact amount. You're going to lose 1 million or 1.2, but the possibility, like, is this what would happen generally in the industry? I think that yes, I am going to give you a very short question. So we have Microsoft ordering 1,000 Intel chips at 100 USD. They're manufactured using bad materials. They catch fire on the production line, destroying the assembly machine, which is worth 1 million USD. Microsoft fails to launch a new device before Christmas, missing out on 100,000 in profits. I want you to take a moment, maybe together in groups of 2 or 3. I will share the document which I just typed now with you, and I can give you 3-4 minutes. Anybody who wants to try? Anybody with a number? Going once, going twice? Yeah. Sorry? All of it? Yes. Why? Right. Christmas sales will be predictable. And here we have damage directly caused. Okay, yeah, so I agree. We would. Let me see, let me just switch back. So how would we think about that? The thinking would be straightforward, basically. It was 110, so the chips. Chips were 100 chips. Was it 10? Yeah, 10,100. Well, let's go with that. At 100 USD, yes, they can recover. Why? Because they were defective. before the risk passed. We had assembly line. Yes, direct damage. That was 1 million. It was a consequence of chips being bad. And then profits. Yes, it is reasonable to expect that Christmas profit may be lost. If they claimed here like, oh, by the way, we lost profits from Mars or whatever, NASA, the question would be, yeah, but was it reasonable for a person contacting you to anticipate that? We will practice this more. It is time for you to catch a break. Then we're doing a tiny bit of more calculation.